This was a quick, I hope, little video just to talk about journal entries and posting to the ledger. I know that we've posted some long videos and had long discussions about working through problems, and you know, it can seem daunting when you look at what's going on there. But here's the journal entries that we worked on before for Fast Forward Company. And if you think about it, when you create journal entries and when you post journal entries to the ledger, you're doing the same thing repeatedly. For example, all you do is you analyze the transaction and post and record it in journal entry form. You know how the date works. You don't have to learn that. You know how the description works. You don't have to learn that again. All you've got to do is figure out which accounts to put these in, and you just do that over and over again. Once you learn how to do it, it's easy as pie. So Fast Forward receives $30,000 from Chaz Taylor in exchange for common stock. We got $30,000. That means cash came in. Cash is an asset, increased by debits. So as I analyze it, I need to increase cash, which would be to debit cash. So it would be this: debit cash. Here's the date. Common stock, he received it in exchange for common stock. Common stock is an equity account, goes up or is increased by credits. So I'm going to credit common stock. That's all I'm going to do. It's just do that over and over again. Fast Forward purchases $2,500 of office supplies for cash. Well, cash is going to go down because we're paying out cash. It's an asset, so we show it going down or being reduced with a credit. Office supplies is an asset, so we're going to be increasing that asset. That's a debit, and we just record that in a journal entry form. Office supplies going up with a debit, cash going down with a credit. Got the date in there, got a description in there, we're good to go. And you just do that one entry, one transaction at a time. When you post to the ledger, see if I can find the ledger here, all you're going to do is take this information that you've already recorded, and it's a simple matter of just entering this amount as a debit into this account. That's all you got to do. So I'm going to take $30,000 and I'm going to post it as a debit transaction into the cash account. So 202, can't remember what it was, 2021 is what we're using in there. 2021, December the $30,000. Balance is $30,000. And you know that this is a debit balance. I mean, it is one of the things that you know now. So I've posted that. This is account 101. It came from page G1. So all the little dance steps we do are just kind of automatic at this point. I'm going to post this to the common stock account. It's a credit. All I got to do is go find common stock and post it as of December the 1st. And we know that's a credit balance there. It came from G1. And I'm going to post it. I'm going to record it here, or do the posting reference over in the journal again to 301. And that's all you're going to do. It's the same thing that you're going to do every time. Office supplies, we've already, just same situation. I'm going to debit this account. So all I got to do is find that account. It's an asset, so it's going to be up near the top. There it is. Now we're going to post to cash. The main thing is that you need to understand how assets are affected by debits and credits, how liabilities are affected by debits and credits, how equity and revenue are affected by debits and credits, and how expenses and dividends are affected by debits and credits. Once you understand that and understand the accounting equation well, then it's just a simple matter of being able to put these things in the little pigeonholes where they belong, and then organizing these posting references so you can find them later. And then after that, it's just a simple thing of going down and getting the last balance in an account on the date. If it was December the 2nd, we wanted to get the balance, we could get the balance on December the 2nd. Well, that's going to be the same balance that it is on December the 30th if I don't have any more transactions. But the last balance in the account is going to give me what that account balance is, of course, and that'll be my trial balance. And then I'll take my trial balance, I'll start at the bottom, use revenues and expenses to get my income statement. In fact, I think I have one here. Here is one. You can see the balance in dividends before it was closed was $7,600, and we know that's a debit balance. Here's dividends with a $7,600 debit balance. Computer services revenue has a credit balance of $41,274. That's a credit balance, we know. $41,274. So that gives us our trial balance. And then we just roll up our trial balance. I call it rolling it up. We start at the bottom and we take our expenses and our revenues and we create an income statement. That gives us our net income. From there, we take our net income, beginning retained earnings, which is 0 in this case, add our net income, subtract away our dividends, and that gives us our ending retained earnings. And then we just start up with equity, liabilities, and assets. Here's my current assets, my long-term assets, total, liabilities, and they're all current liabilities in this case, no long-term liabilities. Then our equity, common stock, and retained earnings. Remember, retained earnings has all the information in it that came from all the revenues, expenses, and the dividends that were distributed. All those numbers are melted down and condensed into this one little number here. And so our total assets equals total liabilities and stockholders' equity. So there you go. It's a simple process. There's a lot of steps, but once you know or understand the concepts and have the skills to do it, you can repeat these steps over and over and over again and get to the end. We talked about closing the books. This was our trial balance before we closed the books, and see dividends and revenues starting here and going down. These are all the temporary or nominal accounts. Once we do our financial statements, we can close those accounts, which means zero them out, and you see they have no balances now, and all those numbers are up here in retained earnings. So our post-closing trial balance will be much simpler, and you will do that in chapter 3, but not to worry about that now. Anyway, don't let the number of things that are happening cloud your understanding. All you're doing is the same thing you've done several times before. You're analyzing a transaction, recording it in the journal, and then posting those numbers to the ledger. That's all you're doing.